Hey, good morning, everyone. I'm low energy this morning, but some economic data just came out that I think is important for all of us to take a look at and understand. So I jumped on as soon as I could to be able to share this information with you. So let's get right into it. What I'm referring to is the out of the Federal Reserve Bank of Philadelphia. They collect this data. It's their July 2022 Manufacturing Business Outlook Survey, right? So every month they do a survey with businesses to see what the outlook is. And they just came out with theirs for July. Manufacturing activity in the region declined overall in July. So obviously not a good thing that manufacturing declined. The survey's indicators for current general activity and new orders declined further into negative territory. So further into negative territory. And I have a chart on this that I'll bring up. The shipments index was positive, which is great. So they're shipping more orders, right? And actually rose slightly, while the indices for inventories and unfulfilled orders were negative, right? So inventories are going down because they're shipping more, and unfulfilled orders were also negative. So overall, not a positive look here for the manufacturing business outlook. So let's continue on here. So the index for current general activity decreased for the fourth consecutive, right? That's why I highlighted this fourth consecutive month, falling 9 points to a negative 12.3 in July, right? So the fourth consecutive month that it's fallen, not a good sign. The index for new orders declined for the second consecutive month from negative 12.4 to negative 24.8. However, the current shipments index rose from 10 to 14.8. So great. They're shipping stuff. They're reducing their backlog is actually what's happening. And they're not getting new orders to backfill, right? The index for new orders declined for the second consecutive month, right? So they're not getting new orders to backfill for those that they are shipping out. So again, just overall not a positive sign. So here's the chart that they've put together. Goes back to about 2007, 2008 here, and you see the activity. But you see where we are here today, right? In 2022, this is what they're talking about. The activity has been coming down really since late 2020, right? So you see that activity here. And so what I want to do is I want to switch over to another chart. So let me stop sharing that because it's important to understand some of this dynamic here. And so that's what we do. We kind of dig into the data and try to understand what the heck is going on and what does this predict, right? Is it, predicting a recession? Is it predicting a depression? What's it predict for? In this chart here, I'm going to share with you unemployment, right? What does it predict there? So this in blue here is the same as the previous chart. This is what's referred to as the diffusion index. So, and you see, this is where we were on the previous chart. We've been going down since late 2020, right? This is where we were on the previous chart. We're right here now at this point in green, okay? But let's go back in time. What I did was I overlaid the unemployment rate in red, right? This red line is the unemployment rate. So when the diffusion index goes negative, one of the things that it signifies is this gray band here, which is a period of time for when we were in a recession. Okay, so that's what this gray band here means. So when we go negative in the diffusion index, that's an indicator we are in a recession or will be going into a recession, right? But what does that mean for unemployment? Well, you see here, it's gone up, right? A little bobble in the upward direction, right? So anytime you go negative with the diffusion index, you tend to have an increase in unemployment sometime later, right? These things don't happen in tandem. And that's why we look at these charts to help folks understand, almost like a crystal ball, what's potentially and probably going to be happening here, right? That's why we do these sort of videos to help people understand things so they can navigate their own businesses, right? That's what we're trying to do. We're trying to help folks here. So if this is something you like, you resonate with, share it with your friends, right? So they can survive this storm that we are potentially heading into, right? They can watch this and they can derive from it what they will, come up with their own assumptions and make their own determination. All I'm doing is providing data that hopefully will help people think a little bit more in terms of what the future holds, right? So again, here, diffusion index goes from a high of 60 to a negative 60, right? So big drop here. We were in a recession for a longer period of time. And again, when the diffusion index goes negative, what do we see to unemployment? We see it head higher, right? In this blue circle that I made here, you see it head higher. Same thing here. We go negative. We have a uptick in this blue circle. We have an uptick in unemployment. Same thing in the early 80s. Diffusion index goes negative. We have unemployment. Everywhere we had negative diffusion index, we see unemployment to some degree go higher, right? Look at 2008, the GFC, right? It went negative. Look at unemployment. Unemployment, looks like it almost doubled, right? Early 2020, that's almost an anomaly because we were locked down by the government. It was a forced shutdown. So this is almost an anomaly here, or it is an anomaly here. So we can't really take too much from that. But I think we have enough history going back to the early 70s to show what may be coming down the road in terms of unemployment, right? With this index going negative, chances are we are going to see unemployment on the rise. So I took the liberty to pull together a couple of other articles that I thought might be worthwhile to folks. So here's one from Reuters. When did this one come out? This one just came out today, 9 o'clock this morning. So the U.S. Weekly jobless claim hits a fresh 8-month high. So, right, this is what we're talking about. This data all correlates. And I think this unemployment, this jobless claim is just going to continue to increase, okay? As economic activity, as business activity continues to soften into the future here, right? So we hit a fresh 8-month high. What do they have to say? So the number of Americans filing new claims for unemployment benefits rose for a third straight week, right? Last week to the highest in 8 months. Wow, I didn't know that. So the highest in 8 months, suggesting some cooling in the labor market amid tighter monetary policy and financial conditions. And this isn't going to change, right? This tightening of monetary policy is not going to change, right? We saw the Fed increase their Fed fund rate in June by 75 basis points. And now we're looking into July. At the end of July, chances are they're going to increase it again, right? Maybe another 75 basis points. And then they have the month of August off. And then September, they'll probably adjust it up again. We're all thinking it's probably around 50 basis points, right? So as they continue to tighten monetary and financial conditions here, right? This cooling in the labor market is just gonna continue to increase, right? The cooling will continue to happen, okay? So what do they say here relative to the labor market? There have been reports of layoffs in the interest rate sensitive housing and manufacturing industries. Despite some loss of momentum, hiring has remained robust. Okay, so despite momentum. So we all know we've been in a housing frenzy here for the last 2 years, if not longer. and hiring has been good in that industry. Actually, contractors and such builders have had trouble finding good good people, good labor to work in that business, right? But with these interest rates going higher, that will have a cooling effect on a certain portion of the housing market. And we're already starting to see that. Here's an article that came out June 21st. So again, today, again, it's all relevant and timely information that I try to bring this to you and why I want to jump on. So Lennar starts cutting prices in the cooling U.S. housing market. All right, so they're saying things are cooling. So what else? What else do they have to say? Lennar has started trimming prices, not only trimming prices, but they're also offering buyer incentives in some areas of the U.S. to bolster sales in a cooling housing market. All right, so let's, so this is something now we kind of keep our eyes on what's happening in the housing market. Are they experiencing layoffs? Are things getting, softer economic conditions? These all play together and we all watch them. So rapidly rising mortgage rates and economic headwinds have depressed new orders for houses and buyer traffic in June and increased deal cancellations. So what's happening with deal cancellations is, people signed on with a builder, say 6 months ago, a year ago, to have a house built when mortgage rates were 3%. And now what's happening is as they get closer to completion to be able to actually deliver that new home, these buyers that were there when the mortgage rate was 3%, they're looking at mortgage rates in the high fives or 6%. And so they're looking at it and they're saying, I can no longer afford it at 5.7% mortgage rate, right? Or 6% mortgage rate. So they're canceling their orders, right? So that just puts more inventory on the market. And depending on how much of that happens, that could have a softening effect on the housing market. And you see it here that it is. Lennar, one of the biggest manufacturers of homes, is seeing just that and why they're offering incentives. So this was an interesting statement here. So for now, Lennar is sticking with their earlier forecast for deliveries of about 68,000 homes for this year. The catch is that with the demand now starting to wane after the pandemic boom, current attempts at guidance are tantamount to guessing and not guiding, right? So these are the actual words from the executive chairman, Stuart Miller. And he said that in the company's earnings statement. So let me go through that again. So he had said that the catch is that with demand now starting to wane after the pandemic boom, current attempts, these are his words, current attempts at guidance are tantamount to guessing versus guiding, right? So here we are, an executive chairman who's basically saying, we don't know which way this is going, right? We're guessing at this point, right? With rates increasing, with potential unemployment increasing, they're guessing at some of these numbers is the best they can do, right? And he said that in a company's earnings statement, right? That's the thing that kills me. That's pretty significant, to share. So what I want to do is I want to take a look. Let's take a look at a couple of more charts here. So this one is the unemployment rate. It goes back all the way to the 1950s. And so what I wanted to bring out in this one was just something curious that I observed, right? Again, these gray bars on the chart is a period of recession in our history, right? So this was a period of recession. Look at when unemployment peaks. It peaks typically at the end of a recession, right? That's when unemployment peaks, right? So we're in a recession now. There's no doubt about it. There's a lot of experts and thought leaders that I speak with who are very much on that same page. We are in a recession right now. I think the Fed knows it. I think the politicians know it. However, they are not going to come out and say it because it has a negative impact on the work they are doing. So, so if we are in a recession now and things are just going to continue, we don't know how long, we don't know how deep this recession is going to be. However, what it shows is the future of unemployment is going to be something higher in the future, right? Next month, 6 months from now, a year from now, very high probability unemployment is going to be higher. And so we all need to look at what does that mean for us personally, and what does it mean for our businesses, okay? So I just wanted to share this little curiosity that I found showing unemployment peaks after a recession typically ends. And we're just getting into one now. So, and then one other interesting chart I wanted to share off of the Shadowstats website. And if you're not familiar with Shadowstats, take a look at their website. Gives a lot of great data here. And so this is the unemployment chart that they provide. It shows what the official, in red, what the official unemployment rate is, what's being reported by the government, right? In terms of U3, there's different types of unemployment. There's U3, which is reported out to the public. Then there's U6, which includes more folks that are unemployed that have already fallen off of the claims report, but are still unemployed, right? So that would be higher. But the curious thing here is what Shadowstats provides, which shows that our current unemployment rate is at 25%, right? And why do they provide that? Well, what happened was back in the early 90s, it doesn't show it here on this chart, but the government changed how they calculated the unemployment rate, and they did it to benefit the government, right? And so, the biggest deviation we see here is, around 2008, 2009, where you start to see this deviation, right? the U.S. government is showing unemployment going down, where Shadowstats is showing if we were to calculate it the same way as the early 90s, it would actually be going up slightly here, and then it curves down a little bit. But the point here being, if we calculated unemployment the same way we did back in the early 90s, we would be around 25% of our population is unemployed, right? Which should scare people because going from here, like the previous charts, the previous articles that I shared, it's looking like unemployment is going higher. Okay. So what does higher mean? Does higher mean we're going from 25% to 30%? 3 in every 10 people are going to be unemployed. Again, just an interesting data point that I share. Okay. And then the other thing I share is, some of the interviews I've had, maybe you've seen them. I've had people on my channel who have said the system died in 2008. And again, this is just one of the charts we can draw from. And I need to do better on my channel when I have these interviews to help bring out clarity in some of these statements folks say, because this is just one of the charts that we turn to kind of reveal what actually is going on in the system, right? And so this is just one thing. We can look at gold when other countries started buying gold, right? China and Russia started buying gold heavily in 2008, right? So a lot of things happened in that 2008 period where the system just died. And so that's where a lot of these smart people that I listen to, I follow, I learn from, help me understand what's going on. And so anyway, I wanted to share those couple of charts with you and those articles with you because it's very timely. Just came out today, as you saw in those articles, in that data from the Philadelphia Fed. So hopefully this is helpful. If it is, please hit the like button. I'm not going to edit the video. I'm just going to throw it out there because I think it's timely and important. So enjoy, folks. Thank you.